And you started a recording, is that correct?
I just started the recording. Welcome, everyone. We're going to talk today about actually my favorite topic. I get real excited anytime we talk about correlations. I don't have in this, I can only show so many slides because this is, I promise everyone today's presentation is 1 hour. So I took the slide out, but I had in this presentation a couple slides that reflect back prior blog writings that I've done over the years talking about correlations, and it's I'm very passionate about it. Um, it's fascinating to me to see the markets, the dynamics and the different dimensions of the market pull apart, come back together, and over the long term, it's recurring patterns. And I'm referring to rotation flows, and I'm referring to cycles in the markets involving all the asset classes, such as the stock indices, the bonds, commodities, currencies, and so forth. Um, and sometimes they pull apart, but they, you know, 10 out of 10 times they come right back together. It's just a matter of timing. And that creates opportunities. So tonight's class, we're going to talk about how to profit from rotation flows. A lot of you in the room are long-term members, and so you're going to be very familiar with it. Uh, I see some new names. You might not be as familiar with it, or maybe you are. But I promise you that by the end of tonight, you will have, hopefully, you'll take away some ideas that if you take it in, you'll be able to see it in the markets in the next following weeks, if not days. This past Sunday, or every weekend, I write a report called The Week Ahead. Here's one from this past week, and I mentioned the recent steep sudden sell-off that we saw last week in German bunds, Japanese government bonds, treasuries, and other global fixed income instruments suggests a potential liquidity problem may be surfacing. Did you guys hear some of that today on CNBC? And not only did I write about it this week, this past weekend, I wrote about it the weekend before. And in the weekend before, I had gold in the spotlight. And I said the rally in gold coincided with the steep sell off in the US dollar. Let me see if I can pull this one up so you guys get to see it. I'm giving you the backdrop for the lesson. That's what I'm doing. Here's the prior week. It says here gold was on the spotlight, providing multiple trading opportunities with a strong rise in volatility. Metal surged Monday and Tuesday before falling sharply at the end of the week. The rally in gold coincided with the steep sell-off in the U.S. dollar. The bearish breakdown in the 10-year note futures helped us identify gold as an ideal market to sell short, and go on to talk a little bit more about the relationship between stocks, bonds, dollar, and it helps us spot money flows and rotations. And ultimately, what this does for me is that it helps me select the markets that are poised for powerful moves. So when you hear Ken saying it was a volatile week last week, but we happen to do well, we strive when the markets become volatile. And we strive because our approach, what I'm going to show you this evening, helps us to look at the markets like a chess player. We visualize two or three potential trades or potential moves in the market that translates into potential trade setups. And then, boom, if they do begin to develop, we take advantage of it. We're there. A little bit about us. We have been awarded a Trade Titan by Dr. Dean Hanley 3 years in a row. That's 2%. We're in the top 2%, globally, and we've been able to do it 3 years in a row. And what you're going to see tonight, well, we've been doing it forever. I started my career 26 years ago. I started out as a portfolio manager with Prudential's quantitative managed account program, mostly stocks and bonds. And there I was taught sector rotation, and that's in stocks, and that's basically companies that are related to different sectors of the economy, such as staples, energies, even commodities, and so forth and so on. And after leaving the bigger firms to set up my own firm, that's been really the cornerstone of what I established the company. I've received several awards and some of them are from big groups like Franklin Templeton Group and Oppenheimer Funds. I am a professional money manager registered with the proper authorities. And Augustine, which I don't know if Augustine will have the time to come in, but Augustine runs our trading room. And what you will hear me talk about tonight, Augustine puts it into play every morning. I actually come in at the end of the trading room session, but Augustine starts it and he does 80% of it. Augustine joined us approximately 2 years ago, maybe a little longer now, and he does an excellent job. Rotation flows. To understand rotation flows, you got to understand a little bit about how the markets work. Let me see if I can get a pointer here. Yeah, you all see the red dot? Do you all see the red dot? Okay.
It's there, Joe.
All righty. As the markets go from one stage to the next, it usually, more often than not, it starts to trigger different sectors of the market and different asset classes. Back in 2008, when the markets collapsed, we were in a stage 4. We went on to a stage 1. When you do get to stage 2, then there is fear of potential inflation, and the Feds and the central banks begin to raise interest rates and so forth. Stage 3, you start feeling the effects, and then the cycle begins all over again. But right here, 4 and number 1, especially when it transitions into 1, it's a low inflation environment. Deflation at times is often heard. And I am bringing this up because you've probably been hearing a lot for the last several months whether the Feds believe that there's no more fear of deflation. In fact, some are saying that potentially the move that we've seen in the bond market coming down so hard, pushing interest rate yields higher, is a belief that there is inflation and not a fear of deflation anymore. I personally don't believe that. I personally believe there's a liquidity problem in the bond market, and it's been a crowded trade. But nonetheless, it doesn't matter. Those are just my opinions. Time will tell, and we try to apply what you're going to see today by reading the market's message. It doesn't matter what I think. I'm going to do what the market is telling us. And we've got technology to do that, by the way. This is not a discretionary thing where I just, all of a sudden I'm enlightened. No, nothing like that. You will see most trading days, monies or positions initiating and unwinding of positions that occur between treasuries, stocks, commodities, foreign currencies, and cash. This we see. What I'm going to show you today is how to identify and why this occurs. And when you're able to identify these rotations and these flows, how you can prepare and select the markets that are most poised to move. Bond yield and currency. Gold has been demonstrating a direct correlation with bonds and inverse correlation with interest rates. At times, gold has a fear premium factored in, not so much as an inflation premium, but a fear premium. When bonds go down, interest rate yields go up. That's what we have been seeing these last few trading sessions. Probably a week and a half, maybe 2 weeks, of bonds coming down, yield going up. It wasn't that long ago. I think it was last month. Germany and certain places in Europe, there was a negative yield. Well, guess what? Not anymore. Now bonds are coming down, yields are going up. And gold fluctuates with this. Okay, there's a very tight correlation there, and this is and here's the proof of it. This is where the 10-year yield, the real yield once you take inflation into effect, and the price of gold. So when the 10-year yield was at 5%, gold was trading at $471. When yields dropped to 1%, 2%, that's when we saw the price of gold go up so high. Now, that doesn't mean that as we day trade, every time the interest rate yield moves, gold moves. It doesn't on a day-to-day basis. For the most part, they do. Now, as a day trader, knowing this relationship and having the tools to identify it, it can give you quite an edge when the correlations are tight, when the correlations are there, and all of a sudden you see the 10-year notes approaching a critical level, and your signal in gold is not even there yet, but it's coming, and you're ready. Yeah, Mark, I'm answering questions at the end, and I'm going to answer some questions in the middle. We're going to take a break in the middle of the presentation. I'll take that time to answer questions as well. There's nothing formal about this presentation, Mark. There's nothing formal, so it's very relaxed, and it's not canned in any way, shape, or form. Here are other markets and other relationships that exist with bonds and gold. The Swiss franc. 25% of Switzerland's reserves are backed by gold. U.S. bond yields drop, dollar falls for the most part. Okay, dollar likes a high yield environment. That has been the case for the last, I don't know, couple years when interest, I'll tell you since when, since March 2013, when all of a sudden interest rates started inching up, currency market took note, and the dollar began to gain, and has rallied strong. What we've been seeing these last 2 weeks is the unwinding of those trades. And to be honest with you, it's not the relationship that we've seen these last several days where we've had notes, bonds go down, stocks go down and the dollar go down is not the norm. That is not the norm. That doesn't mean when correlations are not tight and they're loose, it doesn't mean uh, that correlations don't work. They do, but they're not always going to be tight. When they're loose, you got to step back and trade with caution, with a lot of caution. When correlations are tight, oh, it's like what? It's like a Swiss clock. You're watching this Swiss clock just work, and it's fascinating. And that's when trading really is fun because, again, like a chess player, you get to see these setups in advance. Okay? Also, when the markets are loose, the correlations are loose, well, sometimes it might be telling us something, and we have to listen to what the market's message is. Back in when was it? Was it 2008? A few months before that, there was the correlations were all screwed up. Even though the S&P closed flat for 2 or 3 days, sectors inside the S&P that normally have a very tight correlation were trading 30% off of each other. Looking back, that was the canary in the coal mine. So when correlations turn upside down, it's usually a sign that something's not right. And it's a time to step back and trade with caution. Hostile environment. All right, so what does all this mean in the market today, right now? Well, I wrote in the week ahead that maybe there's a liquidity problem. And on Monday, when we did the theme for the week, we said we were going to there's talk about maybe a problem in the um, not just the bond market in general, but corporate, the high yield bond market, maybe. When the markets get crazy, like these last few days, where pundits on TV that are supposed to be experts are scratching their heads and are saying, I don't know why the dollar's doing this today. And I mean, I heard people like what's his name, Cashin, old timers that they're usually when the markets really go crazy, they're usually the ones that they have there to make sense of things. And these last today, yesterday and today, it's been a little what's the right word to use? Challenging as far as what is the market's message. All right. Also, commodities. We've got Australia is the third largest gold producer. Canada's fifth. New Zealand's also a large gold producer. And these foreign currencies are going to move at times with commodities. If you know this and you are a Forex trader, you just gained an edge over other Forex traders. We are considered multi-asset traders. We look at the markets as from the top down, which is also considered macro traders. That's when these relationships stare at us, and wow, they're easier to identify. So for those that are in the room that are just FX traders or just S&P traders, you're going to gain an edge if you take a little bit of time out and learn how these different markets are related to each other. Crude oil trades a lot with the Canadian. Boy, we've seen that. I think we had a trade last week in the Canadian. Was it a short Canadian? think it might have been a short Canadian trade, and that's I think the first day in the last two weeks that crude oil also came down. There's a relationship with the dollar and crude oil. The CME about a year and a half ago came out and said the concept of risk on, risk off trading has won increasing interest and popularity in recent years. There are, of course, many ways to construct transactions that are sensitive to these macroeconomic conditions. So one of the things that we do in trying to pick up on these rotation flows is market sentiment or market environment. There are some basics. Risk on, risk off is a basic market environment. Risk on is when traders or investors take greater risk for greater opportunities, potentially greater returns. The huge movement of large institutions and investors, all in or all out of asset classes, has caused many assets to become highly correlated. We've had this for a while, but since 2008 up to recently, it's been risk on or risk off. This past year and a half, we started to see other market dynamics that were more typical of years past starting to come back into the market, which is good, which is real good. The carry trade. The carry trade. How many of you here have heard of the carry trade? Not being a Forex trader. A lot of Forex traders know what the carry trade is. There's a few of you that have heard of it. Carry trade is when you borrow in a cheaper currency to reinvest for a potentially higher return. Before 2008, before the financial collapse, our average interest rate, a basket of treasuries, would yield you 5 to 5.5%. U.S. treasuries. In Japan, you could borrow in yen and pay half of 1%. So there's been a institutional and your mega funds and your mega investors that would borrow in yen, reinvest in either treasuries or stock markets or emerging markets. Since interest rates collapsed after 2008, the popular trade for carry trade has been borrowing in yen, reinvesting in stocks, equities, S&P, the Nikkei. And even Europe. Understanding the dynamics can help us trade the Japanese yen, can help us trade the S&P, can help us trade even bonds. Understanding and being able to identify when these institutions put on these trades and when they unwind the trades, wow, they be powerful moves. And it's nice to be able to pick up on it and get ahead of that move. This is an article that came out in the Wall Street Journal not that long ago, a couple months ago. Computer-driven automatic trading strategies score big. So-called quant traders take advantage of volatility. That's us, folks. That's us. Recent market volatility caught many flat-footed. Among the few winners were traders who let a computer be their guide. That's what we do, and we're going to show you how we use computers, having the knowledge of how the markets work and how rotations, how these cycles take place, you got to marry it to something. And we have technology that in a nanosecond can tell us what's basically going on in the markets with these rotation flows. We were the first to introduce the first automated trading execution system for Forex, institutional and for hedge funds. 27 different clearing firms have been using it since 2002. We developed about, I want to say about 4 years ago, risk on, risk off sentiment indicator. Not too long ago, probably in the last 3 or 4 months, we developed the rotation flows indicator and the carry trade indicator. This is what it looks like in one of the platforms, and I'll show you how we use this. Let me get my pointer. We break up the markets. Here we're just showing you basically the most traded instruments. We don't have grains on here, even though we do trade grains. But these are the risk assets, which cover the indices, some of the indices, the bonds, the notes, then the currencies, and then the metals. This column will tell us if we are in a risk-on or a risk-off environment. This column tells us if the carry trade is on or off. And this column tells us if the rotation flow is going into foreign currencies or out of foreign currencies. This center column is probably one of the most underappreciated technology that we use. And whether you're a trend trader, mean reversion, or a momentum trader, you want to know if the instrument that you're looking to trade is trending or if it's consolidating. And that's what this box tells us. When this picture was taken of the snapshot of the similar to a market minder in Ninja, it's called Market Analyzer. In TradeStation, it's radar screen, but it's called the Architect for us. And this column tells us if that instrument is consolidating in a range, or if it broke out, or if it broke down. Here's a breakout of the range, it's the US dollar. Here's a breakdown of the range, euro, not surprising. And the others are in the box. How does this help you? Well, if it's risk off, I know what I'm looking to trade, just like carry off and FX up. And if I like trading breakouts, I'm looking at these instruments, or the instruments that are still inside the range. You may want to trade the ones that already broke out. These 3 columns named extreme, this is an extreme 1, 3, and 8. This is a dynamic velocity indicator. Once we have established if we are in risk off, the carry trade is on or off, and what currencies are doing, then we want to select the strongest velocity leader for longs and the velocity leaders to the downside for shorts. Let me go ahead and show you another snapshot. Here's one under a different market environment. Here's one where it's FX up, carry trade is on, and it's risk off. Now, the interesting thing is that even when the markets are doing something completely different and chaotic, like today, and yesterday and last week, we had, I think, 2 days of it. you will see, for example, all of these green, meaning all the money's flowing in there over a 1 hour period, a 3 hour period, and an 8 hour period. And you might see it come right out of currencies, and all these under the currencies would be all red. And the metals might also be, one color or the other, and that's easy to spot. Oh, I know where money's going. Now, why do we break this down in 1 hour, 3 hour, and 8 hours? When we start out the morning, 8 o'clock, 7 o'clock in the morning, we're getting ready to trade. I want to know what's been going on since the London Open. And that's what the extreme 8 hours tells us. It's the strongest movers, and you can sort these by columns. And the mini Russell, whenever this was taken, I don't know when this was taken, was the strongest one, led by the NASDAQ and so forth. Just like during our lunch hour, volume dries up, things consolidate. Well, that's what this extreme 3 does, if you're looking at it at 8 o'clock in the morning, for London's lunch. And this is our pre-open. So this gives us a wealth of information about how trading is setting up for us at the open. It's a global market. Tokyo might not be as important as it once was. There's been a lot more spotlight on Europe and on us. But we definitely, there's definitely a relationship between what goes on during Europe and what goes on during our trading session. If not, just look at the charts at the last 24 hours. It was during London that the markets went nuts. Right, guys? What was it, around 3 o'clock? Gold shot up. Bonds came down hard. Stocks came down hard. Euro shot up. And on and on and on. Okay, so there's a lot of information here, and I'm just, I don't want to overwhelm you. I just want to give you the basics and what it means for us. We also provide you the rotation flows indicator that you can put up on the charts. And this is the carry trade, and this is should be the yen. And you can see how big these moves are when the indicator tells you the flow is there. It's happening. And you can see there's an $1,100 move on the first one and a $1,400 move on the next one. This is commodities. And I believe this is on crude. Now, these moves are just based on the risk flow indicator. Henrik, I'll answer that later on during the break. But no, it's not. That's the beauty of it. It has nothing to do with any lagging indicator. It's dynamic. But yes. So rotation flows covers stocks, covers bonds, covers commodities, and covers currencies. Look at these moves. The rotation flow indicator for commodities picked up long crude, picked up short crude. Terry's asking which platform does rotation flows work? What you're seeing, that's Ninja on that is on my screen right now, but we also use TradeStation. TradeStation and Ninja. We used to have it on Aspen Graphics, but they really priced themselves out of the market. Don't have it on Thinkorswim. Most of our indicators are on OpenECRI. Hopefully soon the risk flow indicator will be on there too, but for right now it's TradeStation and Ninja. Yeah, John, great question. John's asking, are these all one contract? That's just one contract, John. Just one contract. Just like, for those that were in the lab, in our trading room last week. Were you in there, John? We did $3,000 in profits for the week, and there weren't that many trades. But that's just one contract. We've got traders that trade 10 contracts. Others trade 5 contracts. Just multiply it to your account size. Mark is asking questions based on the numbers posted on your website in March. You made 3,300 in the trading room. You lost 3,000 gross profit for the month after commissions close to 0. There is commissions in there, Mark. And it tells you the commission amount in there as well. And Mark, not every month we're not gonna make money every month, Mark. But what you see on there, yeah, 350 for the month was after commissions. It's not a great month. Yeah, but the month after that, I think was 1,900. The month before that was, I think, 2,000. One contract. Last week, $3,000. That's a lot for us for one contract. But Dr. Dean Hanley, who's done the research, I think 4 to 5 years on selecting the top 2% of trade titans and so forth. He dug in there. It's transparent. There's no funny business there. Mark, that's up to 3 contracts, Mark. And then it's averaged out over a year. So, you can have 2 losing months and still make a titan. And that 5,000 is it's not 5,000 per month. I think it's 50,000 per year. So it's a little less, and that's 3 contracts, if not more. We did 50,000 with one contract, if I'm not mistaken, last year or the year before, with one contract. But at any rate, what other questions? Here's another one on commodities. You can see $750 move down, $200 move down. It's not gonna be profitable every time. And this is not even calling the signal. This is just on the rotation flows. So not every trade's going to be profitable. Not every week's going to be profitable. Not every month's going to be profitable. We did a inside the numbers. By the way, Mark, we try to do it at the beginning of the month. We do one of these meetups and we discuss the prior month. We show the trades. And if I'm not mistaken, if I remember correctly, I don't know, Ken, do you remember what we did last month? 1,400. I don't remember what it was, but the first 2 weeks We made most of the money the last week and a half. Somebody coming on? Was it you, Ken, or Augustine?
I was coming on, but I saw that it looks like Augustine's there. He can probably answer it better than I can, since he's he collects the data. Augustine, are you there?
He may not be. He just might have signed in early.
I'll get the data for you, Joe, and
Yeah,
I'll put it
but
in the chat box.
yeah, there's I'll go ahead and address this now because there's a lot of guests that are not members in the room. There's a lot of traders that try to have a fixed goal. They want to make X dollars per day, and if I'm coaching you, that's the lot. I teach against that. I teach against that big time. You're setting yourself up to fail if you think you can make money every day, especially a set amount of money, or if you think you can make money every week. Markets they're not an ATM machine, and our style of trading does not fit every market environment. We're going to go in and out of different market environments. We've been able to be successful over the long term, and we've been running the trading room for over 8 years now, and we've been successful from our ability to be able to identify when the markets are friendly to our trading style and when they're hostile to our trading style. And that's what rotation flows is all about. That's when rotation flows is all about. It helps us identify when the three major markets or the four major markets, stocks, bonds, commodities, and currencies, when they all have the same outlook and they're all positioning themselves with the same forecast of where we are in the business cycle, or others would call that the economic cycle. So, the market tries to anticipate where we're going to be in that cycle 6 months out. So, of course, if you got a economic data report that comes out, or a central banker says something that's out of the norm, they're going to adjust their positions right away, and you're going to see the market react quickly and violently at times. So understanding how these markets work, having the technology to tell you what the big boys are doing in these different markets, then you're able to say to yourself, oh, this is, everybody's doing the same thing. It's easier to trade.
I have the data, Joe, if you'd like for me to read it
Yeah.
off. January of this year, we did a net profit of $1,975.
I'm sorry?
February 2,430. March $551. April $1,491. And May to date is $3,271.
Yeah. So there you have it, folks. The guys that I coach, no, don't set up a daily goal. You're setting yourself up to fail, and I've seen great traders turn into poor traders just by their minds, letting their minds take over. So your goals should be set on taking trades when the markets are friendly for you, and taking or stepping out or trading very light when the markets are not, or when the markets are hostile. That's how you should be rewarding yourself and setting your goals. And what that translates for us is that we're going to have weeks, days where trading is light, or we're even losing money. And then we make it up when the markets get back in sync and we have more trade signals like we did last week. You know, last week we had a great week, not because, we woke up and ate our Wheaties. It had nothing to do with us. What we did last week is what we did the week before, and the week before, and the week before, and the week before. It's up to the market. So when the markets are friendly, we go big. We trade more. When the markets are hostile, we step aside. We trade very light. That's what rotation flows can do for you. Let me see if I have what other slides I may have here. And then, we got plenty of more slides. So let's go ahead and move on. It's getting a little late. Here's a huge move in Forex. That's a $4,000 move that was picked up in, looks like the euro. This is a rotation flow of risk off. It looks like, I think. Yeah, for the S&P. That's a $1,000 move. Oh, I don't have it. Wait a minute. No, I guess that is it. I thought I had a lot more slides, but no, we're right on target. It's almost 9 o'clock. So let's open it up for Q&A. PJ says, we accept what the market offers. We cannot extract funds from the market. Yep.
Yeah, and his comment about we do not get offers every day is a good one.
Isn't that the truth? Guys,
Yes.
and you got to be careful, with your personality and your mindset. There are times, like today, I woke up today, yesterday, I think I only had one trade. I had that British pound trade yesterday, I think, during the trading room anyway. And last week was such an exciting week. I woke up this morning so eager to trade. I was, my enthusiasm was there, my motivation was there. And I opened up these charts and it's like, whoa, everything happened. It happened during London. It's too late. There was nothing to do today. We were in our trading room where we normally have 3 or 4 trade calls. I don't think we had one. Did we have any? No, right, Augustine? I don't think we had one trade today. So it is what it is. David's asking, what's the typical amount of time that you stay in the trade once you're in it? David, we have 2 styles of trading, and they're both day trading, even though you can have some positions that you put on as a day trade, and you may be able to keep it for 2 or 3 days if you want to, if it's going in your favor. But my favorite style of trading is momentum. We have trading signals for momentum style traders and for intraday trending traders. The intraday trending style can have you in a trade anywhere from 5 minutes to an hour, maybe. Momentum trading could be anywhere from a minute or 2 minutes, and we're not scalpers. But you could be in a trade for a minute, 2 minutes, or it could last you, 20 minutes, or even more. Especially if they take a direction and they start trending, you can just keep moving your trailing stop. I'll tell you our norm. We will risk $200. Not always. Sometimes risk is only $100. Sometimes risk is $300 or $400. But our norm is risking $200 for the opportunity to make $400, $600, and at times $800. So with those numbers, we don't have to be right all the time. We only have to be right half the time, and we're going to do very, very well. The markets are not always going to have follow through. So you're not always going to risk 200 and make 800. That's not the norm. The norm for an intraday trade might be risking 200 to make 400. Those are more typical, more common. But on those days where the rotations are perfect, they're all in sync, everything's tight, and some of these markets are at break points. We've had $1,800 trades, one contract. Not the norm, but we definitely try to identify those. Those sometimes could last you a little bit longer. So that's not going to be a 5-minute trade. It could be an hour or 3-hour trade on crude oil, gold, sometimes the S&P. What did we do with the S&P? We made $747 with, what was it? The NASDAQ, I think, last week, and the S&P. We also do pyramiding. On that particular trade, I shorted, I think it was my trade. I don't know if it was Augustine's or mine. I think it was mine. I shorted the S&P. The signals were there. The rotation, so it was risk off. Shorted. The first signal was NASDAQ. Had it. It was I was up a couple $100, I think, $250. Decided to then short the S&P. I couldn't add to my position because the signals weren't there, but I had a signal coming up in the NASDAQ. So I risked the $200 that I was already up on, $250. I risked the $250 I was already up on, and I put on a trade in the S&P. Same direction. So it was directional pyramiding, what I call. And we had, $747 was it. What did we risk? The initial risk, I think, was $200. Those are the kind of trades that we look for in our trading room every morning. Yes, David is asking, so you will adjust profit targets and stop losses as the trade progresses. Yes, absolutely. Yep. The only trade I had yesterday, as an example, David, was a long British pound trade, and it was in zone 2, a little bit higher risk because it didn't have the opportunity. It wasn't a risk 200 to make 800. I think it was risk 200 to make 400. And if I would have used just a fixed stop loss and not trail it, I would have made the $400. But I decided to trail it because nothing else was making sense. That was the only currency that was really having follow through. And I think I got out for maybe $180 on a pullback because of my trailing stop. But it's okay, We're okay with that.
Joe, Terry's asking a question a little bit higher in the question box. How does it work on stocks like Apple, Tesla, and ETFs like the SPY and the IWM?
Oh, Terry,
and I think what he's asking is the rotation flow component of it.
The rotation flows works great. What you do is if you're trading stocks, well, if you're trading the spiders, you're trading, that's the S&P. But if you're trading stocks, individual stocks, then what you have to do is find, where does that stock belong? Does it belong in the Dow? Does it belong in the S&P? Does it belong in the NASDAQ or in the Russell? What sector is it in? And then what you do is, if the rotation flows are telling you risk on, as an example, or even risk off, those are stock plays. At least the ones that you're mentioning there. Those are growth stocks that you're mentioning, with the exception of the spiders. So what you have to do is you're talking about Apple and Tesla, yet you have them on your Let me go back. On your next stream, on your you have them here on your architect. You could have this instead of risk assets. You could have stocks. You can have 20, 30, whatever you want in here, and it's your Teslas, your Apples, and then you have, you know, the S&P, Dow, you know, and Nasdaq up here. This is going to sort it by 1 hour, 3 hour, and 8 hour. You're trading the open, so what you want to do is look at, as an example, the Nasdaq, which is mostly growth stocks. Well, were they buying up the indices since London, since the slow period of London, and are pre-open? Are they buying them up? That's going to give you an indication how these stocks are going to open up. Now, what you want to do is that if you're, let's say that here you've got Tesla on top, and you've got Apple at the bottom. You're looking for a long? Go with the leader. Go with the one that has the strongest velocity. That's going to show up on top. You know, this sorts it. I think this one is being sorted by the 1 hour, it looks like. No. By the 3 hour. You can sort it whichever column you want. And Terry, you know, I traded stocks back in the 90s, and I had this in the 90s. And that's how I traded. In fact, I gave a presentation in Omega World 2000 in New York City. Omega World was a trade station, and they used to have once a year a huge conference for strategists and systems developers. When they were building, by the way, the equivalent of trade station for this is called radar screen. When they were developing radar screen, they came to me. By coincidence, I went to high school with the two founders, the two brothers, Cruz brothers. So we knew each other. They came to me and they said, this is what we want to develop. Since you're a trader, what would you want it to do for you? And I had, of course, you know, a long list. And they were at my office for 3 or 4 weeks, breaking it down. I had my own version, but my own version was limited. They took it, they expanded on it, and named it, you know, and that was their radar screen. So when they had the conference, they introduced the radar screen. They had me do it. So I introduced the radar screen to the audience with my methodology, my system, and it's what I'm showing you right here. For stocks, I used the, here, let me go back. I'm going back to the year 2000, by the way. Omega World 2000. Here you go. This exact same picture I used in that presentation. And what happens here is that depending on what stage we're in, stage 1, 2, 3, or 4, you're going to have different sectors of the S&P that are going to outperform the others. So what I did is that I had all my sectors here. Like instead of risk assets, these were all my sectors. So right off the bat, I knew where the rotation flows were. In fact, I remember in 2000, the rotation flow was, or 2000? Yeah, 2000. The last time not the last time, but I did a snapshot for a presentation, and it said money was coming out of the technology. This is the year 2000. Coming out of technology, going into forest and paper as far as sectors. Now, what I did was in the forest and paper, and forest, I had all the stocks, or the top 10 stocks. Henrik, you know this. We've talked about it before. Henrik is a member of ours that trades stocks. And back then, I identified the strongest out of the paper and forest was international paper. So I went with international paper as a long. On the short side, I chose technology, and I chose Intimi because that was the weakest, the velocity leader to the downside. So I did my presentation in Omega World 2000. Well, they laughed at me because they said, "What, are you kidding me? Who the heck wants to buy international paper? It's a $30 stock. It hardly moves. And you're going to short Intimi? Intimi was at 300 and it was down to like 225. They were saying it was a great buy opportunity, buy the dip. Well, what that was telling us, what the market was telling us, it was showing us the first sign of a shift into home builders, into the big real estate boom that we had from 2001 to 2007, 2008. And of course, the technology collapse. Intimi went down to $5. I wish I could make this up, but it's real. And it was using the exact same thing that I'm showing you right now. And that was how long ago? We're in 2015. 15 years ago. 15 years ago, we're still doing the exact same thing. It worked then, it's working now. The difference is that we're doing it in futures. We're doing it in different asset classes, not just the S&P. But the S&P, you have energy, you got crude oil. You know, and then you have other markets. You've got the utilities, which are very sensitive and tied to interest rates. Now, the reason why I made that shift out of stocks in 2001, actually, into futures and currencies is because volatility dried after the NASDAQ collapse. I need volatility. I can't survive without volatility. I'm not going to put on a position and wait 3 months to make 5%. We do that in 2 or 3 days with futures. I discovered back then when I got tired of waiting and waiting for stocks to wake up, to just move on and look for these other markets that have more volatility. And boy, you know, I wasn't let down. It's been awesome. It's been great. It's been fantastic. It's the best move I've done. But as far as methodology, technology, it's the same. I haven't changed. It's all the same. And that's why I get excited every day when I get up and I go into the trading room and I see what Augustine and our members are doing in there. Because I've been seeing this picture for close to 20 years. Over and over and over. It works. And you can do it. But to be honest with you, you got to have the courage. You got to have the courage to try. You got to have the courage to fail. You got to have the courage to succeed. And you have to have the courage to persevere. And traders lack courage. Not all traders. Some traders lack courage. You got to have courage. That's all that's asked of you. You don't need a high IQ. Even though Augustine has a university degree. Do you have your MBA, Augustine? Even though he has a college degree, he worked for a broker friend of mine up in New York. Commodities, futures, brokerage firm. And someone who's very well known as a trader. And he told him he'll never make it as a trader. Passed them on to me. Augustine makes money and he makes it look Easy. Because Augustine had the courage to try, had the courage to fail, had the courage to succeed, and he has the courage to persevere. That's all you need. So what I'm asking you today is to step up. We're going to give you a 2-week training course on this. We're going to give you the indicators to try out for 2 weeks. Have the courage. Try it out. See what you can do. It's a great way to make a living. So what I'm going to do is I'm going to put a link in the text box, if I can find it, and just put your name and email address, and you'll be in the 2-week training course on how all this works and the indicators. 2 weeks. So that's all I'm asking of you. Give it 2 weeks. Any other questions? Everybody get the link?
It's in there, Joe. As far as building the architect with sectors, and I've helped some of our stock traders who use our tools to be able to trade stocks. I've helped them build this. So if this is something that interests a stock trader, shoot me an email and get involved in the trial, because you have to have the tools to be able to do it. Joe, Terry's asking a question there. You want to address that?
Let me see. Terry, it depends, which indicators you like or need. We have subscription models, so it's affordable on a monthly basis, or you can buy the licenses. I don't know if you're a stock trader or what your needs are, but reach out to Ken and he'll give you the price list and what's involved. John V says that Augustine follows the rules and has the discipline. John V, the advantage, and we talked about this, I think, in the trading room today or in the IQ room on Monday. The advantage of being in our trading room every day is to help you with discipline. And we're getting actually some members that are saying, you know what, it's helping my discipline.
So, yeah, folks, this is Ken again. I put my email address in the chat box, so if you are interested in what we're talking about, you can also reach out to me. Shoot me an email, and we'll get you started on your way. Great presentation, Joe.
You like that, huh? I did. If who was it, Terry? If Terry hadn't mentioned stocks, I had no reason to mention Omega World.
Well, it goes to show that this technology and the approach stands the test of time. One of the things that I do when I'm working with folks is let them know that when these indicators were developed and that they've never been updated. They've never had changes made to them, so they work in all market environments, which is, I don't think you see that everywhere. That's pretty cool stuff.
Yeah, that's true.
All right, everybody. Well, I think we're going to go ahead and wrap this up. Joe, you agree?
Yes, sir. We've got the S&P, by the way, that's waking up. You might see that back in bull territory before tomorrow.
Okay, well, we may go into a risk-on environment and have some other opportunities.
All right, everyone.
All right, everybody. If you have anything more, pop it in there quickly. If not, we're going to go ahead and sign off. If anybody would like a copy of the recording, please email me. And oh, David, of course it is. I'll tell you what. Please shoot me an email so I can make sure I can identify you properly. All I need is your email address, and I can get it into the database and put a prompt in there to reach out to you after the middle of June, and we'll get you set up. All right, everybody. Have a great evening. Thanks for joining us.
Bye now.
Good night now.